Hi, I'm Brad Hunter. I'm a family law lawyer, a family arbitrator, and a family mediator. I'm here today to talk to you about how to divide your family property. So what our goal is to help give you some information that will help you deal with your parenting, property division, issue questions like spousal and child support. I want to help you navigate through your separation and divorce so you can move forward. We're here to help you and your spouse come to a settlement that you both can live with. Remember that the toughest decision is to get started, and contact us at the link below. So the first thing I want to point out is that I prepared a free downloadable Saskatchewan separation guide, which provides an in-depth discussion of the things I'm going to talk about in this series and today. You can find a link in the description below. So let's talk about how to divide family property, and it's done pursuant to a law called the Family Property Act of Saskatchewan. It sets the terms of how family property is divided between spouses. As a general rule, all property is subject to sharing. The value of all assets are shared equally is the starting point, and it sets forth the rules as to how that happens and how it is calculated. So who does this law apply to? Well, if you're married, it applies to you. And if you're common law, that means living together 2 years or longer, it applies to you. Sometimes it's not clear whether you're living common law or not, but that's an issue sometimes that we have to deal with. And you must start your case before your divorce or within 2 years from your separation if you're common law. So what is family property? And it's everything. It includes sole assets, joint assets, assets you might own with someone else. For example, if you own a family cottage with family, your share of that is subject to division. Real estate, including your home, farmland, cottages, rental property, businesses, farms, private corporations, all your retirement assets, your pensions, your RSPs, your TFSAs, your RIFs, includes investment assets if you have any, your furniture, vehicles, jewelry, everything is subject to division, including inheritances and gifts. There's two kinds of family property with two different sets of rules. The first is the family home and household goods. Now, the family home is your principal residence, and you can only have one family home. Personal property includes furniture, family vehicles, recreational equipment, things like that. It doesn't include jewelry, heirloom collections, hobbies, business assets. Those are subject to division, but under a slightly different set of rules. It's divided equally in virtually every case, and it does not matter whether it was acquired before or after marriage. It's all in the pot. The second type of assets is everything else. So everything else we've talked about, everything else you have of value is subject to this set of rules. And the big difference is the value at the start date may be exempt from sharing if it's still owned or trustable. So let's say you owned a house that was a rental. It had some value the day that you got married. You're now separating. The value at the date of marriage may be subject to an exemption. Most of these assets are split equally, especially in long-term marriages, but they are subject to exemptions in something called equitable considerations. So how are debts dealt with? Debts are not family property, but are an equitable consideration. What that means is they're usually included in calculating a division. They're not always included. You need to look at each debt individually. So we've talked about property and debts. It's also important to recognize that debts to family members are often viewed with suspicion. So something that was a loan or a gift is often hard to figure out. So when your commencement of accumulation of assets start 2 years after you start to live together, or the date of marriage, whichever is earlier. So if you live together for 3 years and then get married, it's 2 years after you started living together. When does it end? Well, the date of a court action, that's when we do the valuation. In most cases, that's the default. Of course, if you haven't started court, it's a date you agree to, and often people will agree to a date of separation if they haven't been apart for very long. So how do we go about doing this? Well, that's the difficult part. The first thing is we help you to determine all of your assets and debts. We determine if any exemptions are claimed. We provide proof of value, such as RSP statements, bank statements, etc. So you actually have proof as to what's owed. We get proof of value if needed. If you need a business valuation or a house appraisals are quite common. Is there a reason for an unequal split? There are sometimes reasons. It's unusual, but sometimes it shouldn't be 50-50. And then we review options. Spouse keeps the house, the first spouse keeps the house, the second spouse keeps the house, or it's sold. And with all of those considerations, you make a decision on the options that you have. So I just want to go through an example of a couple and how it would work out for them. It's a pretty straightforward example. Lynn and Pat are separating. They own a house, 123 Maple Street, that's worth $100,000. It has a mortgage of $175,000, so there's a net equity of about $225,000 in the house. They each have a TFSA. Lynn has $7,000, Pat has $25,000, so Pat has more. That's the amount that's in for division. They have some credit card debt they've agreed to include. Lynn's is $3,000 and Pat's is $6,000. And they've agreed to split the furniture they have. They're just going to divide it, and they're going to divide their joint bank account. So what are their options? What are the choices they can make? Well, let's go through the first option. So in this one, Lynn keeps the house, and you'll see what we've done is we've totaled Lynn's assets. They're $407,000 if she keeps the house, and Pat's are $25,000. We take off Lynn's debts, and you'll see net assets of Lynn are $229,000. The net assets for Pat are $19,000. And that difference between the two of them of $210,000 requires Lynn to pay Pat half of that, or $105,000. And if she does that on that option, Lynn keeps the house and Pat gets paid out. Just turning things around, let's have Pat keeping the house. The calculation's a little different, and it comes out to $120,000. That's simply because Pat has more value in her TFSA and than Lynn does, and her credit cards don't offset that. So what are their options? Well, Pat keeps the house and pays Lynn $120,000. Lynn keeps the house and pays Pat $105,000. If the house is sold, they split the net equity. Each gets $112,500 from the sale, and Pat pays an additional $7,500 to equalize the other assets, which in this case is the TFSA and debt, and they split their joint account and furniture. And often people will look at the three options we've given, and they'll be making a decision about what they do next. Do they move to buy a new house? How much money do they have to buy a new house? Can they afford to keep the family home? So we'll go through that kind of analysis with you. So feel free to contact me. I'm Brad Hunter at settlenow.online. Please call us, email us, or visit our website. Contact information is below. And feel free to ask any questions, either in the comments below or through email. Remember, the toughest decision is not where to start or when to start. It's getting started in the first place. So contact us. We're here to help. I hope that you have found this useful, and I hope I get a chance to talk to you in the future.